Hello traders, Gary Wagner here, just about 11:25 in Honolulu, 4:25 in New York. It is Wednesday, January 18th, 2017, and this is the Daily Report for Gold and Silver. Following the release of this month's Beige Book, in which the Fed said that the economy is growing modestly, we saw some underlying pressure really come into the precious metals markets. Gold trading lower, silver trading lower, US dollar, of course, gaining some strength on that news. We also recommended that aggressive traders should add to their current long. We're long at 1180. Our recommendation was to add one position to each position you had. That was at roughly 1203. The market is currently trading at 1204. All stops should be at 1195. Of course, we'll discuss that in detail when we pull up our first chart. Silver also trading lower on the day, off by about 6 cents, or about a third of a percent decline at 1708. My recommendation is to maintain our current long position. We have not moved our stops yet in silver, and my recommendation is to hold stops where they are and hold the single position where that is. So traders, first chart that I do want to look at on today's show is a weekly standard candlestick chart. This, of course, of gold futures, the continuous contract. What we can see when we look at this weekly chart is, first of all, we are still solid on the week, meaning the market is definitely trading above where it opened on Monday. However, the second thing that we can easily see is that the majority of the gains that we saw this week have quickly eroded, with the market trading lower today by about $9.40. That's our current print at 1203.50. Now, when we also look at the weekly chart, we can see that as long as it trades above, in my senses, it's got to trade really above 1200, we should be okay. Now, I put in a trade recommendation this morning specifying that this is for aggressive traders, that they can add to their position. Traders taking that call are in roughly 1202 to 1203, which is where the market was trading at when that trade alert was sent out. All stops at this point should be below 1195. The top of this weekly candle right here is about 1197. In fact, let me clear that up so I can move my cursor. But that comes in at 1295.90, so call it 1296. And so in essence, what I am looking to do by moving those stops up yesterday, I am looking to move it just below the lows of this week. Now, I didn't expect to see the market under pressure as we did today. And I do believe that if the market is going to continue in this uptrend before finding its first dip, because obviously this market will be composed of a series of rallies followed by corrections, and we look to earmark the levels and ranges that those particular areas are going to be. But as I said, I have anticipated the market having the ability to move as high as 1251 before finding some real resistance and going into a correction. However, I also have to be cognizant of the fact that really what we need to look at right now is moving back above 1212. Of course, that's the 50% retracement. And as I said, I have support that is genuinely below 1200. Major support, of course, wouldn't come in till about 1173. And that, of course, is based upon this 61% retracement. For the aggressive traders that took the call this morning, maintain your current longs in gold. All stops at 1195. For those that are sitting with their initial position, continue to hold that long at 1180. Your stops are in place at or below 1195. So trader, as far as silver goes, silver trading off today, but not with the kind of percentage drawdown we saw in gold. It's roughly half of that, off about 0.4%, a net loss of about 7 cents per ounce. In terms of support, I believe that we're looking at the benchmarks right in here. Just as we're looking at 1200 in gold, we're looking at $17 in silver. When we draw our line across, we can see absolutely a couple of occasions in which this particular price point dramatically conveyed, well, support here, and then resistance, of course. As you can see, the market comes up, tests this area, and then moves back lower. We know that 1650, which is our 61% retracement, that is major support. And my recommendation is to maintain your current long in silver. We did not add to that, as well as maintain your current stop. In other news, we saw the U.S. dollar on the news of the Beige Book move up tremendously in terms of a net gain, almost a full percentage increase, 101.30. Of course, the market had a low of 132 and the high 101.31, about a 1 percentage swing based upon data that was just released in the Beige Book. In other markets that we are looking at, we had a mixed bag in the U.S. equities markets, with the Dow Jones Industrial Average closing fractionally lower, off 22 points at 19,804, but we are still 200 points away from that elusive milestone of 20,000. Now, when we look at the Standard & Poor's, that closed up fractionally, up 4 points at 2271, and then the NASDAQ also showed an increase, but this increase was about 1/3% vis-a-vis the NASDAQ 100 E-mini at 50.54. So traders, in terms of the other markets that we do look at that we're currently following, the dollar, of course, has been something that we have been focusing on intensely. Of course, because of the net effect that it's going to have in the precious metals. The fact of the matter is that the precious metals, as well as crude oil, are paired with dollars or traded in dollars. So you get a direct correlation between a stronger dollar and weaker gold, or a stronger gold, weaker dollar. So in this case, we had the dollar fall from grace for the last couple of weeks. You can see that. We talked about the fact yesterday that we identified on the weekly chart, which is what we're looking at, this Three River Evening Star that's right here. However, we did not get confirmation the following week. We did last week with this large sell-off. And now when we look at the current activity, and the fact is it's Wednesday, so we're halfway through in the market, the candlestick could end up forming whether green or red based on what happens over the next couple of days. But we can certainly see that we have similarities to 2 weeks ago, and what we're seeing is that consolidation and uncertainty in the market, and it is really revealing itself through this current weekly candle. So traders, I want to take a quick look at oil. Oil was down about 2% today, roughly $1 lower per barrel to settle at 51.38. What we're seeing as what I believe to be really, really interesting is the fact that ever since we witnessed the OPEC accord, which occurred within the last month, we have really seen this market trade sideways. We had net effects of the market moving up. You can see that here, a net effect of the market moving up, but we definitely had some incredibly strong resistance, roughly just above $54 a barrel. We can also say with some certainty that we absolutely have some support in the market at about 51. So our range has really been between $54 and $51 per barrel, and that is the range I would expect it to trade in until we have more fundamental news come out. If it turns out that member nations are breaking the accord and breaking it with a fever, look for a break and a break below this, back towards 50, maybe even 49. However, a side of caution is necessary, because if news comes out that the member nations are really holding the accord, we could expect support to be found in this area and to move back up to these recent highs. So traders, with just 2 days to go until Inauguration Day and Trump becomes our 45th president, I believe we will continue to see uncertainty in the market in terms of the fog lifting and getting some clarity as to what he's able to accomplish and what promises are actually converted into policies will give us that clarity, but that will be over a period of time, whether it's the first week or the first month, until we get some real concrete ideas. And as I said, until then, expect volatility. This has been Gary Wagner, wishing you, as always, good trading. We'll talk to you tomorrow for another daily update and review. Bye-bye.